You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, the year's drawing to a close, and in fact, that's kind of where we're going to start this evening and look at how the portfolio is positioned heading into the rest of the year. And I know you want to start with a chart of the top 40 tonight.
Yes, that's it. We do this most weeks now. We actually start by looking at a bigger picture with the chart of the top 40, just to lay the land in terms of the broader market and where we stand. So there it is. It's up on the screen at the moment. You can see that we had a fairly strong rally from August up into late October, and throughout November the market's generally been pulling back. It's made a feeble attempt at a bit of a bounce over the last 2 weeks or so, but it really isn't feeling that good, I must say. This bounce is feeling very weak, very lethargic. So I'm not quite sure where we go to from here, whether we bounce higher or whether we have another move to the downside. But whichever way it goes, I'm not really all that concerned. The reason being, the way we positioned and the way I plan to run this portfolio out into the December futures closeout, which is on the 17th of December, we've got an option structure. It was a put option structure, which we've described at length on this show many times. And then what I did is I went partially long against that put option structure. Now, the put options work for us on the top 40 below 46,000, and the put options will make us money below 46,000. I then went long at 46,000 to the tune of about 60% against our put option structure. So what it equates to is that from 46,000 up or down, we will make money. Below 46,000, we're essentially 4 Rand per point short on the market, and above 46,000 Rand, we're effectively 6 Rand per point long. So I'm slightly skewed in favor of the long side, looking for a bit of a rally into the end of the year. Whether or not that materializes, I'm not really sure. But as it stands, I'm kind of sitting on the fence here, as you can see, but I'm very, very unsure as to which way this market's going to go from here, whether it breaks up or down. But either way, we're sort of looking good, provided it moves away from 46,000 in one direction or the other. The worst case scenario for us would be for the market to close out at 46,000 on the 17th of December. Then we would make pretty much no money on this whole thing, which would be disappointing. But look, on the bright side, we won't lose anything either.
Yeah. Okay, so you're hedged on both sides of the equation. I know you want to put forward a few scenarios. So what could actually happen between now and that futures closeout, which is, I mean, we've got, 2.5 weeks essentially of decent trading action left for the year.
Yes.
So what could actually happen, and what's some of the factors that we need to bear in mind?
Yeah, well, there's a couple of important things coming up during the next 2 weeks which we need to keep in mind. And I'm going to sort of lay these out there and then put a bit of a scenario together, the way I potentially foresee things unfolding. So a couple of important events to look out for. The first one is this week, Friday, the 4th of December. There's a ratings review by Fitch, one of the large ratings agencies. Now, they are always a little bit behind the other ratings agencies in terms of adjusting their ratings. So as things stand at the moment, you could say Fitch have got us on sort of the best rating in terms of South Africa's rating. The likelihood is, and the market's very much pricing in the fact that Fitch is probably going to downgrade us to triple B minus, which would then put Fitch in line with Standard & Poor's, and then those ratings agencies would all be on a par in terms of their rating for South Africa. The problem is that all of these downgrades that we've seen gradually over time have put us closer and closer and closer towards getting towards junk status. And you don't want to be in junk status, because then suddenly you fall out of a whole bunch of investment baskets worldwide. It costs you a lot more money to borrow in the international debt markets and so on. The problem is, so we've got this Fitch ratings review coming on Friday. S&P, Standard & Poor's, will also be adjusting this, but the likelihood is that they're most likely to adjust us to a negative outlook.
Yeah, so it's not quite a change in the rating. It just means that they've got you on a watch.
That's
they call it ratings watch negative.
Correct, that's it. So it won't be a change in the actual rating, but it's almost a warning to say, be careful. You're in line to be downgraded. And the caution with that is that if Standard & Poor's do put us on negative watch, which is also what the market seems to be pricing in, that even puts us one step closer towards being downgraded to junk status, which potentially, if they follow through on that could come to fruition next year sometime. And the concern is that these ratings agencies have been warning and warning and warning the things that need to happen in order for us to sustain some sort of an investment grade rating. And it relates to things like the economic growth rate of the country. It relates to things like the current account balance and things like that. It relates to the public sector wage bill. And basically all of these things have largely been ignored. So I think and unfortunately, it looks as if we're drawing ever closer towards a meaningful downgrade for South Africa, which is really not good news.
Not good news, although as one of our guests said on one of our shows recently, maybe actually a crisis is what we need to concentrate the mind, because sometimes that is the case, but it's going to be painful. And I think the forecast for the rand are weakened to 14.50 by year end.
Yeah.
I've seen some forecasts for 15 easily.
Yeah.
By
Well,
the
I
middle of
mean,
next year.
we're already at 14 Rand 44 today.
Yeah,
so
that's not much of a stretch.
It's another
actually.
0.5%, and we're at 14.50, and to get to 15 Rand is also just a hop and a skip. So it's not looking good for us at this stage. And that's the first thing I think we've got to be careful of.
Okay, so it's the ratings, because that's going to have sort of, as you say, knock-on effect. It'll be on currencies, it'll be on bonds,
Yeah.
possibly some of the domestic SA
Yes.
Inc. stocks, banks, etc.
Yeah, and I think a lot of that, the market, you can see, has been adjusting to this outlook to a certain extent already. Have a look at the way the banks have been trading. Our banking stocks have been very weak. And a lot of my colleagues have been saying, but the banks are so cheap. There's so much value there. Yes, maybe there is, but the thing is they look like a value trap. And if it's going to become more and more expensive to borrow on the international market, that could be a reason why our banks are lagging. So I think just be aware of that. The second thing to keep in mind, and this is going to be a biggie, is the Federal Open Market Committee meeting in the US on the 16th of December. And Janet Yellen is very widely expected to announce a 25 basis point hike in the interest rate then. The markets are now pricing in a 73% likelihood that she'll hike the interest rate. So I think, to me, it's as good as a slam dunk that this is done. And the market, to a large extent, I think, has priced this in already. It's going to be very, very important to watch the commentary and to see. Now, my suspicion is that she's likely to say, right, 25 basis points hike, market's expecting that, and then probably paint a relatively dovish tone. And the market, I would think, will take kindly to that if she does paint a fairly dovish outlook. To my mind, the Fed has always been so very careful about managing and massaging the market's expectations in terms of raising interest rates. They've been very, very careful not to shock the market. I don't see any reason why they would suddenly do an about turn now and do something aggressive.
In fact, it might shock the market if they don't do anything.
Exactly.
So,
Yeah.
Okay. So
and that's, the scenario that I'm going to paint very much centers around the fact that I think we'll get the rate hike, but the outlook from Janet Yellen is going to be quite dovish. And that'll probably lead to a weakening in the US dollar and so on. The thing after that, though, is that keep in mind the 16th of December is a public holiday in South Africa. So we then have a day off, and the next day we come back, this futures closeout, and we have to then account or adjust for what the Fed meeting decided the night before. Now, anyone who can remember last year's December futures closeout, it was a very similar sort of backdrop. We had the public holiday, and then we had the futures closeout the following day, and
extraordinary volumes.
Extraordinary volume, and also it was the biggest single-day rally I've ever seen. The top 40 futures rallied almost 2,000 points last year on the December futures closeout, and that was because the market was caught very short, and the Fed came out with a very dovish tone. So I think that we run the risk of having the same sort of thing play out again here this year, where we have a public holiday, we come back, it's the futures closeout, so we've got all this volume to try and adjust on the futures closeout day, and in addition to that, we've got some potentially positive news that might have come out from the Fed overnight. So I think this futures closeout on the 17th of December is going to be very, very interesting.
Although, having said that, maybe because there is so much expectation of a rate hike, that it's priced into the market, therefore it won't come as too much of a shock, and there maybe might not be so many short sellers in the market as there were this time last year.
Look, it's possible. I mean, if we've learned anything from last year's December futures closeout, if I was running a big book, and I wouldn't want to be aggressively short going into this Fed meeting, that's for sure, because I think you stand the chance of getting a hiding if the scenario that I'm painting does play out.
Now, if they do hike rates, what is the implication for the dollar? Because I know that you've got a view on the dollar and also consequently a view on commodities. And
yes.
I guess that's where a lot of the carnage has taken place in the market.
Yeah.
But maybe there might be some respite.
I think there might be some respite. So this chart of the US dollar index we showed on last week's show, we're going to look at it again now. Now, what's quite interesting is to note that throughout 2015, it's mostly gone sideways and traded into this triangle pattern. We've recently seen the dollar index breaking out to the top side of that triangle pattern, which is a bullish development, and it does point to ongoing dollar strength. However, I do get the sense that the market's probably got a little bit of ahead of itself in the short term, and this US dollar is extremely overbought now as things stand. And my sense is that it's probably pricing in the entire 25 basis point US interest rate hike. And if you have a look what's happening here, although the dollar is making new highs, there's negative divergence on the relative strength index. And when you start to see that, that is very often an early warning sign that the momentum of this trend is running out of steam. And it very often preempts a pullback in the other direction. So the thesis that I'm painting here is that the dollar's run too hard. We're going to get a US rate hike, but Janet Yellen is probably going to be quite dovish in her outlook. And if that is the case, then I think the market's going to adopt a buy the rumor, sell the fact type of scenario for the dollar. And you'll probably see the dollar begin to weaken a little bit on the back of that Fed announcement. And then you could very well see that US dollar index trading back from its current level of about 100. You could easily see it strengthening 2 or 3, maybe 4%. On the back of a dovish commentary from the Fed.
So, I mean, maybe that's a sort of a trading suggestion, but what about the impact it may have on commodity markets? And the last 2 weeks have been absolutely horrendous for them. Gold, copper, iron ore, Brent crude.
Yeah.
Do you think that if the dollar does weaken, then there might be a little bit of a relief rally there?
I would think so. You know, the commodities have been very, very weak on a strong US dollar. So if you see the dollar reverse course a little bit and begin to weaken, then I think the likelihood is that you could see a bit of an oversold bounce in some of these commodities. So I'm just going to show the gold price and the copper price. I mean, but obviously there are a variety of others, like you said, oil price, iron ore, etc. So the gold price, if you have a look, I mean, that's not a great chart, but it's trending down. There's no doubt about that. But you can see that this channel is very much still intact here. And we're right now at the bottom of that channel, down at about $1,050 an ounce. What's interesting here is that notice we've got now positive divergence on the relative strength index and on the stochastic oscillator, whilst this gold price is making new lows. What that is warning you now is this is sort of the inverse of the US dollar index. It's saying to you that the downward move that we're seeing in gold is probably starting to run out of momentum, and we're likely to see a trend change fairly soon. And that would certainly play out, I think, if we saw the dollar begin to weaken. So my sense is that the gold price is probably in a short-term buying area now for a bit of an oversold bounce, and that would most likely come about on a weakening US dollar.
And similar with copper?
Very similar with copper. You can see again copper's been hurt, particularly over the last month and a half, where commodity prices have been under a lot of pressure and the US dollar has been very strong. And again, the same sort of story plays out. You've got positive divergence on your relative strength index. Your stochastic is extremely oversold. And it does look as if the copper price is beginning to sort of form a little bit of short-term basing activity here. So again, if you see a scenario where the dollar begins to weaken, then I think there's potential that you could see a little bit of a snapback rally in the copper price.
And then, I mean, how would that affect the resources index? Because really, that chart since October is dreadful.
It is dreadful. I mean, there's no doubt. And in fact, this chart is now plumbing new lows beyond the 2008 lows. So it's desperately weak. But again, we're very, very oversold. On this resources index chart. You can see that on your relative strength index and on your stochastic oscillator. We have seen evidence of a reversal yesterday, being Monday, on the resources index. So my sense is that maybe we're getting to an area where this resource index has done its thing on the downside for now, and we could stage a little bit of an oversold bounce. And again, it talks to the whole theme. If the commodity prices bounce, if the dollar begins to weaken, as I suspect it might, then I think there's probably a tradable bounce coming in the resources sector here.
Very quickly to end off, Garth, what does the portfolio look like?
One last thing quickly. This is very interesting. Just have a look at these two graphs here. This is the top 40 index of 2011 at the bottom of the graph and 2015 at the top of the graph. You could be forgiven for thinking that those are the same graph. It is unbelievable how similar the pattern of trade has been throughout 2015 compared to what it was in 2011. So I just think I'd put this up here for interest's sake. And if last year's, if 2011's trade is anything to go by, well, maybe we do have a final push out into the end of the year. We'll see. Yeah. And if we do, it's probably going to be led by the resources sector.
Yeah. Well, let's hope so. Okay, so portfolio to end off with?
All right, portfolio is 355,000 Rand. So that's up 42% for the year to date. And those are the positions we've got open at the moment. It's our put spread option structure, and then we long a couple of contracts of that top 40 micro CFD. So that's how it stands, and that's likely how it's going to stay leading out to the end of the year.
Yeah. Okay, Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is, of course, editor and founder of Traders Corner.